All right, welcome to the Explainer. Today we're going to break down the blueprint for building real, lasting wealth in the stock market. Now, this isn't about gambling or some get-rich-quick scheme. This is all about a solid, proven approach that's based on thinking like an owner.
Okay, so before we dive into stocks or any of that, we've got to ask one really important question. Seriously, how you answer this one thing is going to shape every single financial decision you make from here on out.
You see, this whole approach to building wealth that actually lasts, it all starts with getting the foundation right. And it all boils down to knowing the huge difference between these two ways of thinking. So think about it like this. On one hand, you've got an investor. They're buying a piece of an actual business, right? They're becoming a part owner, and they're focused on where that business is going in the future. But a speculator? Nah, they're just making a bet on a ticker symbol. They're not buying a business, they're just renting a stock, hoping for a quick flip.
And that right there brings us to the most powerful tool an investor has: time. And I'm not talking about a few days or a few months here. For this strategy to really work its magic and ride out all the market's crazy ups and downs, you've got to be thinking at least 10 years out, minimum.
And if you need proof of just how powerful time is, check this out. Over a 20-year stretch, an investor who put money in the S&P 500 on the worst possible day of each year still walked away with a fantastic 10.5% annual return. The person who magically picked the best day, they only did a little bit better. What does that tell you? It's crystal clear. Time in the market beats trying to time the market every single time.
All right, so you're in it for the long haul. But where does the money actually come from? It's not just the stock price going up, you know? Your total return as a shareholder is actually held up by three distinct pillars. Yeah, think of it like a super sturdy three-legged stool. The first leg is capital appreciation. That's the obvious one. The stock price itself goes up. The second is dividend income, and that's real cash paid directly to you. And the third, which is one people often forget about, is share buybacks, which is a more subtle way for companies to send value your way. So capital appreciation is your growth engine, right? It's the company plowing its profits back in to get bigger. Dividends, that's your steady paycheck, like collecting rent. And buybacks? Well, that's like the company taking a few slices of the pizza off the table, which makes your remaining slice just a little bit bigger. The really great companies are masters at using all three. Okay, so we've got the mindset. We know where the returns come from, but how do we find these amazing companies in the first place? We need a blueprint. How do we spot the businesses that are actually built to last? And the single most important idea here is what's called an economic moat. Seriously, just like a moat around a castle keeps invaders out, a company's economic moat is this durable advantage that keeps competitors at bay and protects its profits year after year. So where do these moats come from? Well, they come in a few flavors. It could be a brand that everyone knows and trusts, like Coca-Cola. Or maybe it's super high switching costs. Think about what a pain it is to change banks. You've got network effects, where a service gets more valuable because everyone's on it. Hello, Facebook. Or it could be a simple cost advantage, like Walmart. These are the real deal, the sources of lasting power.
Now, here's the best part. You don't have to just guess if a company has a moat. You can actually see it in the numbers. Look for something called Return on Invested Capital, or ROIC. If a company can consistently earn more than 15% ROIC, that's a huge flashing sign. It's basically screaming, hey, I've got a killer business model that my competitors just can't copy.
All right, so we know how to spot the A players. Now it's time to actually build the team. How do we assemble these great companies into a portfolio that's strong and resilient, built to last?
And rule number one of building your portfolio is strategic diversification. But listen, this isn't about trying to hit home runs. This is pure defense. The whole point is to protect yourself so that if one company goes down, it doesn't take your entire life savings with it. It's about preventing a catastrophic loss.
And you know what? For most of us, the easiest, most effective way to do this is with low-cost index funds. Seriously, you buy one S&P 500 fund, and bam, you're instantly a part owner in 500 of America's biggest companies. Talk about spreading your risk.
But then there's that big question. When do you invest? What if you put all your money in right before a crash? Well, that's where dollar cost averaging comes in. It's simple. You just invest the same amount of money on a regular schedule, like clockwork, every month, every 2 weeks, whatever. It takes the emotion and the guesswork completely out of the equation.
Okay, the house is built. Now for the final step. We have to put on a protective coating. We need to defend all our hard work from the two things that will silently eat away at your wealth: fees and taxes.
Let's talk fees first. You see a 1% fee on your investment account and you think, 1%, what's the big deal? But let me ask you, how much does that tiny 1% really cost you over a lifetime of investing?
Just look at this. It's absolutely staggering. On a $100,000 investment, that tiny 1% fee will cost you over $146,000 in growth over 30 years. A 2% fee, you can kiss almost $300,000 goodbye. Fees are like a constant drag on your returns, which is why hunting down the lowest cost funds you can find is a non-negotiable part of the game.
But here's some good news. The tax system actually rewards our patient buy and hold strategy. If you hold on to an investment for more than a year before selling, you pay a much lower tax rate on your profits. The short-term traders, the flippers, they get hammered with much higher taxes. Patience literally pays.
And that brings us full circle right back to where we started. All of these ideas, finding great businesses, diversifying your portfolio, keeping your costs down, all of it gets supercharged by the one ingredient you control: time. Time is the engine of compounding. It's what makes this whole thing work.
So there you have it. That's the blueprint. And it really leaves you with one final question to ask yourself. Are you building your financial future on the solid rock of an owner or on the shifting sand of a speculator? Because that choice, right there, makes all the difference in the world.